going to get to another trending ticker that we are watching today. Kroger, the groceries chain's third quarter sales falling short of expectations. The CEO saying the company expects the macro environment to remain uncertain in the near term. Meantime, Kroger's $24 billion acquisition of Albertsons remaining on hold after the FTC sued to block the merger, alleging that it is anti-competitive. Joining us now, we've got a special guest, Jennifer Rie, over at Bloomberg Intelligence as the senior litigation analyst. Jennifer, it's great to see you again and have you on. You believe the FTC is going to win this case. Talk to us about why.
I really do think so. I attended most of the trial, and I think that the FTC really laid out a great case to show that in numerous, actually over 1,500 markets in the U.S., that the combination of these companies just leaves too few choices for consumers who are grocery shopping. That's the way a deal like this would be looked at, because people obviously shop locally, so you have to look at, many different local markets. And I think even in sort of different market definitions, in some market definitions where they included only really traditional grocery stores, and in other market definitions where they added in super centers and stores like Costco or Sam's Club, I think their economist did a really good job showing that there are markets that would be overly concentrated and that the remedy proposed by the companies just would be insufficient to fix that problem.
What would be that remedy as proposed by the companies? Is it keeping open a certain percentage of the store count of both entities to make sure that they're not just removing some of that optionality from the market?
Yeah, so what they've proposed is to sell almost 600 stores, a mix of Kroger's stores and Albertsons stores, to a company called C&S Wholesale. So really what they have to do is replace the competition that has been lost by virtue of their combination. So create another option for grocery customers in those local regions where the deal ends up being overly concentrated. So normally, something like that sounds like a pretty good remedy. It sounds like it could be sufficient. But the thing about C&S is that it's a very successful wholesale company, but doesn't really have a lot of retail experience. And they'd be taking on almost 600 stores when at this point they operate, I think, only a few dozen stores under the banner Piggly Wiggly, I believe. And they'd be entering regions where they're actually not currently doing business. And the FTC, again, in court, made it sound like a very arduous and complicated process to rebanner the stores and get the private label products that they need, enter supply contracts. That just sounds really tenuous, like it might not work. And I think that they may have convinced the judge that that remedy to that buyer isn't going to be good enough.
Jennifer, I'm curious in the context of kind of the broader market when it comes to regulation. We've seen some bankruptcies come off the back of, the decisions from the federal government and the likes of Spirit, for example. Is that a consideration at all in these decisions, that if a merger doesn't go through, the companies involved might have to close, and therefore, of course, that would have an impact on access to food, for example, in the Kroger case?
It can be a consideration in some cases, but technically the companies have to raise that at trial. They have to put in evidence showing, but for this deal, the seller is likely to be a less viable competitor or may exit the market entirely. There is actually a defense called flailing firm or failing firm that can be used and can sometimes save problematic deals. But in this case, the companies didn't make that argument. And if they didn't make that argument, it's not technically something the judge should be considering when she makes her decision.
As we're kind of evaluating this deal, I almost forgot that Kroger reported earnings today. And as we're thinking about what the company has had to say, talking about the business being more diverse than ever, a model that gives them confidence in their ability to deliver on their guidance right now and generate attractive and sustainable returns for shareholders, I imagine that if this deal does not go through, how much of that capital they might need to reposition towards just investing in some of their customer experience and making sure that shareholders see a broader vision forward, sans a deal here.
Right. And, that's what the antitrust authorities would like to see. Rather than using that capital to buy a competitor, use that capital to reinvest and to improve your quality for consumers and your choice from consumers, and basically just compete harder. And so that kind of an outcome would be ideal in terms of the way the antitrust enforcers might be viewing this.
I'll tell you what, Jennifer, you took me back with the Piggly Wiggly mention. Not even back that far, to the summer, actually. Piggly Wiggly, Hilton Head, South Carolina. Shout out. Jennifer, thanks so much. Appreciate it.
Thank you.